Whether you're paying a friend back for lunch or splitting a bill for that thing you just bought online, financial tech apps are, well, they're everywhere. They've made managing our money so much faster, so much easier. But here's the question. Is all this convenience coming with some kind of hidden cost to our security and to our wallets? We're going to take a closer look.
And really, that's a question we should all be asking ourselves. Because while we're all busy tapping and swiping away, a major consumer watchdog has been digging into the fine print and flagging some pretty serious potential pitfalls.
That's right. Just recently, Consumer Reports actually went before a House Subcommittee to sound the alarm about the risks we all face with these new digital products. And their core message was simple. Innovation is great, but it should never, ever come at the expense of our protection.
So what's really at the heart of this? It's that classic conflict, right? The race for new, shiny technology versus the very real need for clear, strong safeguards to protect us, the consumers. This quote from Delicia Hand, a senior director at Consumer Reports, just hits the nail on the head. Nobody is saying we should stop progress. This is about making sure that progress actually benefits everyone, not just the tech companies building the apps. So what are these hidden dangers they're talking about? Let's dive in and see what Consumer Reports actually found when they put some of the most popular fintech products under the microscope. Okay, first up, P2P payment apps. You know them, Venmo, Cash App, Zelle. They are incredibly popular for zapping money to friends and family in an instant. But what happens when a payment goes wrong? And this is where it gets really tricky. Consumer Reports found that a lot of us we're confused about our rights. If you accidentally send money to the wrong person, or worse, you get scammed, who's responsible? The app? Your bank? You? The answers are often buried deep in these super complex user agreements. And don't even get me started on the fee structures, which can be just as murky. All right, let's move on to another category that has absolutely exploded. Buy now, pay later services. You see them everywhere at online checkouts. They let you split a purchase into smaller, often interest-free payments. Seems harmless enough, right? But there's a lot more going on beneath the surface. See, the convenience of buy now, pay later can actually hide your true financial picture. It's almost like debt in disguise. And trying to get a refund if you return something, it can be a total nightmare. Plus, because you might be using different BNPL services at different stores, it is incredibly easy to lose track of how much you actually owe. This stacking of all these small debts is a huge risk. Next, we've got the really broad world of digital banking and crypto apps. This covers everything from your own bank's mobile app to the platforms where people are buying and selling digital assets. And across the board, Consumer Reports found this consistent pattern of uncertainty. People are worried about hidden fees, they're not sure what happens to their data, and they don't know if they have any real protection if their account gets hacked or a crypto platform just disappears. There's this constant fear of losing access to your own money with absolutely no one to turn to. So all of this leads to a really critical battle that's brewing in Washington. We know these problems exist, so what are lawmakers planning to do about it? Well, it turns out there are a couple of bills making their way through the process that have Consumer Reports deeply, deeply concerned. Okay, let's break down these two bills. First, you've got the Financial Services Innovation Act. This would literally let fintech companies ask for a pass, a waiver, on existing consumer protection rules, all for the sake of innovation. But CR says, wait a minute, you're removing safeguards right when automation could cause problems for millions of people all at once. Then there's the Earned Wage Access Act. This one relabels those early paycheck products so they aren't technically credit. Why does that matter? Well, it could block stronger protections at the state level and fails to set any standards to make sure these products are actually affordable. And if these bills pass as they are, the result could be what Delicia Hand called a recipe for consumers bearing all the risk while companies capture all the benefit. It's a system where innovation helps companies make money while we're left holding the bag when things go wrong. So what is the alternative here? How do we encourage innovation but still make sure our wallets are protected? Well, Consumer Reports laid out a pretty clear path forward for Congress. They use this really powerful analogy. We can't have fewer cops on the beat. Now, in this case, the cops are the Consumer Financial Protection Bureau, the CFPB. They're the main federal agency that's supposed to be protecting us in the financial world. And CR's argument is that instead of weakening the rules, we should be strengthening the agency that actually enforces them. So what's the game plan here? What is CR's call to action? Number one, empower the regulator, the CFPB, so it can effectively police this market. Number 2, set up clear affordability standards so these convenient tools don't become debt traps. Number 3, demand transparency. That means no more hidden fees, no more confusing rules. And finally, number 4, uphold accountability. New tech shouldn't get a free pass, it should have to meet the same safety standards that already exist.
Which brings us to the final, and maybe the most important question. In this super fast, ever-changing digital world, when you tap a button and your money disappears, or you suddenly find yourself in debt you didn't expect, who should be on the hook? The company, the government, or you? The answer to that question is going to define the future of our financial